Hello, I'm Sam Nussbaum, Product Specialist at DoubleLine, and today I'll be discussing a topic that's likely at the forefront of many investors' minds so far this year, which is the U.S. Treasury yield curve. I'm joined by Greg Whiteley, DoubleLine Portfolio Manager and head of the DoubleLine government team. Welcome, Greg.
Thank you.
Greg's been working together with DoubleLine team for over 3 decades and has a unique insight into the Treasury market, so very happy to have you, Greg. There's been quite a sell-off in Treasury yields on the long end of the yield curve so far this summer. We've moved up by about 150 basis points from the beginning of the summer in terms of the yield on the 10-year note through the end of October. So curious to get your perspective on perhaps what the fundamental drivers of that long end sell-off has been recently.
This is really the third 150 basis point sell-off that we have had since the Fed tightening cycle began back in 2023. This one has been a bit more disconcerting because it went through levels that were widely thought to be fair value for the 10-year, 4 to 4.5, 4 to 4.25. People were thinking. We ended up going very sharply to 5%. On the fundamental side, I'm looking, of course, at growth and inflation, expected growth and expected inflation, and the Fed's reaction to that, how the Fed is managing that, reacting to that, and how investors are reacting to the Fed and the Fed's reaction function. So growth is looking to stabilize, although it has been much more resilient than people had expected. Labor market remains strong. Fed has responded by continuing to push rates higher to bring inflation down to their 2% target, something they are absolutely committed to doing. Each of these 3 sell-offs, this one included, I would say, really have ultimately been Fed-driven, with the Fed, in a sense, being the most fundamental of fundamental drivers. Their unrelenting hawkishness, the rate rise campaign that took short-term rates higher than anyone had expected a year ago or 2 years ago, and their total focus on price stability.
Yeah, so that's certainly the fundamental side of the picture, but then there's clearly a lot of technical drivers, and one of the narratives of those technical drivers of the rate sell-off has been the supply-demand picture for Treasuries. So could you walk us through that situation too?
The most recent 2 refunding announcements were something of a shock to the market. Treasury indicated substantially higher borrowing needs at each of those, and substantially higher coupon Treasury issuance and bill issuance at each of those. CBO projection for the deficit as a percent of GDP is not going down anytime in the next 5 years. So it's a topic that's gotten sharply increased focus over the past few months, but it's not a pretty picture technically, with Treasury supply rising and likely to stay high, and some typical investor groups stepping back. Foreign investors are an example of that, typically price insensitive foreign buyers, a lot of it due to currency, are not showing much interest in Treasuries right now, leaving domestic investors to pick up the slack.
Yeah. So certainly a confluence of factors driving the sell-off in the long end. As it relates to the short end of the Treasury yield curve, which is very sensitive to changes in monetary policy, we've now basically priced out any more hikes to the Fed funds rate, and the market has now switched to pricing in cuts in the future, along with the Fed's own projections. In their latest summary of economic projections, the median forecast is for 50 basis points of cuts in the next year in 2024, with the market pricing in slightly more, right, closer to 100 basis points. So what, in your opinion, is going to knock the Fed off of its own plotted course in terms of cutting rates next year?
Right. I don't think there's much that can knock the Fed off course, given their absolute commitment to this price stability idea. So the market typically has priced in Fed rate cuts somewhere like 6 months to a year out, and those have consistently been removed from market pricing as we've gone forward, and the Fed has not capitulated or done a pivot. So I expect that to continue. We've taken out expectations of a near-term rate hike, but well, up until about 2 weeks ago, the last FOMC meeting, we'd been taking out expectations of Fed cuts in 2023, or sorry, 2024. So we are restoring some of those expectations of price cuts now based on Powell's comments at the last FOMC meeting. But if you look out longer term, the SOFR futures market that goes out 5 years, we don't see an expected Fed funds rate below 4% for that entire period. So the market is coming to accept this higher for longer idea. And I would characterize this rate rise over the past 3-4 months as the market doing that, internalizing this or accepting the fact that it's a new, longer, higher for longer world now.
Yeah. So given the sell-off and the breaching of that 5% level on the 10-year note and the 30-year bond yields, do you view the Treasury market as broadly attractive today?
I think it is broadly attractive on a tactical basis. I was looking for a 50 basis point retracement from 5%. We got that remarkably quickly, but my modeling still shows the Treasury market to be cheap versus fundamental drivers, investor expectations of growth and inflation and forward Fed policy. So I think there's room for rates to come down further. I would caution, though, an issue that Jeffrey has been raising really for years, but again recently, we may not get the rate relief in the next recession that we've seen in past recessions. Lower demand because of slower economy, lower demand for credit, but a flood of Treasury issuance as the deficit rises as a percent of GDP going into a business slowdown.
Yeah.
So kind of, well, I would say guarded, neutral, longer term, optimistic, I would call it bullish on a tactical basis near term for a few months.
Yeah. So maybe cloudy picture for Treasuries in the long term, but certainly in the near term, an attractive market setup for investors. And of course, in the context of diversified portfolios here at DoubleLine, certainly a good diversifier away from other parts of credit sensitive assets in the fixed income space. So yes. Thank you very much, Greg. Appreciate you joining us.
Sure.
And thanks for listening.